You spend months building a Bitcoin strategy. Backtests look incredible. Then live trading destroys your account. What went wrong? The answer often lies in two opposite extremes, overfitting and underfitting. Dissects both, plus a third, more dangerous problem, using concrete examples and evidence. In quantitative finance, we build models to capture patterns in market data. Underfitting happens when a model is too simple to grasp the real structure. Overfitting happens when a model learns the noise as if it were signal. The ideal is a model that captures sustainable signals while ignoring random noise. Think of model complexity as a spectrum, too simple on the left, too complex on the right, with a sweet spot in the middle where the model generalizes well to unseen data. Let's compare two strategies on the same Bitcoin data. The Underfit strategy uses only one parameter, buy when price is above the 200-day moving average, otherwise stay in cash. Its backtest shows 11% annualized return, a 38% maximum drawdown, and a Sharpe ratio of 0.4. The Overfit strategy, however, is a monster of optimization, 50 parameters including EMA lengths, ADX thresholds, RSI levels, ATR filters, volume conditions, and even a rule to avoid trading on Tuesdays. After 50,000 parameter combinations, it achieves 187% annualized return, an 8% drawdown, and a Sharpe of 3.1. But when tested on a different period, the Overfit strategy collapses to -14% annualized and a Sharpe of -0.3. The Underfit strategy, while modest, may be more robust. To evaluate any strategy, we use the Sharpe ratio, which measures excess return per unit of risk. It's calculated as the average return minus the risk-free rate, divided by the standard deviation of returns. A higher Sharpe indicates better risk-adjusted performance. But beware, a high Sharpe in backtest can be a red flag for overfitting. A simple SMA 200 rule might underperform not because there is no pattern, but because the model lacks the capacity to express it. It ignores current volatility, trend strength, false breakouts, volume, bull or bear regimes, momentum, and volatility scaling. These factors can be crucial for adapting to changing market conditions. Without them, the strategy is like a one-size-fits-all suit that fits no one well. It may miss profitable opportunities or take excessive risks during turbulent times. Overfit strategies memorize the historical data's quirks, not the underlying market structure. They might include bizarre rules like, don't trade on Tuesdays or, reduce position size between 3 o'clock and 7 o'clock Universal Time Coordinated. These rules have no economic rationale, they just happen to work in the backtest. When applied to new data, they fail because the noise they capture doesn't repeat. The out-of-sample collapse is the classic signature of overfitting. Annualized return converts a series of returns into a single yearly figure, assuming compounding. It's calculated as the product of daily growth factors raised to the power of 252, trading days, -1. This metric helps compare strategies with different time horizons. But remember, a high annualized return in backtest can be inflated by overfitting. A common mistake is equating simplicity with underfitting and complexity with overfitting. That's not always true. A strategy with just 3 parameters, momentum, volatility scaling, and a trend filter, can be robust and profitable for years. Conversely, a machine learning model with 50 parameters might not overfit if it has enough data, proper regularization, and rigorous out-of-sample or walk-forward validation, and if the variables have stable economic or market mechanisms. The key is matching model complexity to the effective information available. The concept of effective information is central. It's the ratio of true signal to noise in the data. If you have more parameters than effective information, you risk overfitting. If you have too few, you underfit. This is analogous to the signal-to-noise ratio, which is the ratio of signal power to noise power. In practice, we can estimate this by cross-validation. If a model's performance degrades significantly out of sample, the effective information is low. When developing strategies, we face 4 distinct problems. Underfitting means we fail to capture real patterns. Backtest and live performance are both poor. Reasonable fitting captures stable patterns, with good backtest and decent live results. Overfitting treats noise as signal, leading to excellent backtest but poor live. The most dangerous is data mining bias. We test thousands of strategies and pick the best, which is almost certainly overfit. This is also known as multiple testing, data snooping, or selection bias. Even if each individual strategy is simple, the process of testing thousands and selecting the best introduces a severe bias. For example, an AI generates 10,000 factors and picks the 20 with the highest Sharpe. Those 20 are almost certainly overfit, even if they have few parameters. This is multiple testing or data snooping. To avoid this, we must guard against not just parameter overfitting, but also factor overfitting, strategy selection overfitting, regime overfitting, and multiple testing bias. These combined are the real pitfalls of AI-driven strategy discovery. In summary, the key to successful quant strategy is balancing model complexity with the effective information in your data. Avoid the extremes of underfitting and overfitting. Use out-of-sample testing, walk-forward analysis, and regularization. Be wary of data mining bias when using AI to generate factors. Remember, a strategy that looks great in backtest may fail live. Always question whether you're capturing a real market mechanism or just memorizing noise. Your engagement helps us create more content like this. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.